Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know, first, UK's £20 billion fiscal gap signals new tax hikes, putting the government on a collision course with the Bank of England's inflation fight. We'll analyse why this policy collision matters now and how it could trigger a recession before inflation is controlled, impacting the pound. Second, a new Bessent Doctrine signals the end of the presidential put as the US prioritises its China trade war over Wall Street's stability. In this episode, we'll break down the end of this unspoken government guarantee and what it signals for investors and market volatility. Third, Netherlands' green energy boom backfires, causing a €35 billion grid crisis that now threatens a bust in the renewable sector. Today, we'll take a closer look at this infrastructure bottleneck and its implications for Europe's green transition and reliance on China. The most unexpected news in the finance world today comes out of the UK, where after a £40 billion tax hike last year, the government is now signalling another major financial shock is on the way. UK Chancellor Rachel Reeves has just gone on the record stating she is now looking at further measures on tax and spending ahead of next month's budget. This is a dramatic reversal from previous pledges not to raise the country's biggest taxes. We previously analysed how tight self-imposed fiscal rules were already boxing policy in, and the latest development is that Reeves is now openly preparing to lean on both sides of the ledger to make the math work. On top of the £40 billion in tax rises already enacted, some analysts estimate the Chancellor must now find an additional £20 billion through either new tax hikes or deep spending cuts. The goal is to meet what she calls her non-negotiable financial rules as borrowing costs rise. Continuing our last discussion about weak growth per person across the G7, plugging a £20 billion gap now risks deepening that per capita squeeze, even if the headline GDP number looks okay. This is where the situation takes a more complex turn. These self-imposed rules create a major policy difference between the UK and other large economies. We're seeing the US and the EU allowing for more flexibility in their national budgets to support investment and growth, while at the same time, the UK is choosing a path of fiscal consolidation, basically tightening its belt. This decision could put a cap on the UK's economic growth compared to the rest of the G7. A while back, we flagged that the UK is already running hotter on inflation than the EU and is exposed to global fragmentation from USSR-China trade frictions. Today's tilt toward consolidation could widen that growth gap if external demand softens. This all begs the question, where will the money come from? The Chancellor has been tight-lipped, but reports suggest everything is on the table. This includes freezing income tax thresholds, a move that quietly drags more earners into higher tax bands as their wages rise. So, what does this mean for the average person? It's a classic example of a stealth tax known as fiscal drag. Here's how it works. When tax brackets don't rise with inflation, any pay raise you get to keep up with the cost of living can push you into a higher tax bracket. So, even though you're earning more money on paper, your actual purchasing power, your real disposable income is eroded. Essentially, this is a way for the government to increase tax revenue without officially announcing a tax rate hike, and it can lead to a sharper slowdown in consumer spending than many expect. And remember, we've noted before that on a per-person basis, the UK has been at the bottom of the G7, so the bite from fiscal drag lands on already stretched households. New taxes on landlords and even higher levies on betting companies are also reportedly being considered. Now, get this, a strategy of targeting specific sectors like property and gambling sends a very particular signal to the market. The real issue here is that it concentrates regulatory risk. Long before any new tax is actually implemented, the mere discussion can deter investment and create uncertainty in those industries. Investors become wary, wondering which sector might be next, which can have a chilling effect on the broader economy. The core conflict is clear. The government is now caught between its 2024 manifesto promise not to raise income tax, VAT, or national insurance, and the stark economic reality it faces. The opposition is already framing this as a tax doom loop, with Shadow Chancellor Sir Mel Stride blaming the government's economic mismanagement. This financial reckoning is happening under a global microscope. While the International Monetary Fund, or IMF, projects the UK will be one of the fastest growing G7 economies this year, it also forecasts the nation will suffer the highest rate of inflation in that group. We previously analysed that combo as a classic stagflation warning headline growth up, but with the heat of inflation still on and little improvement in prosperity per person. So how can we have high growth alongside the highest inflation? This apparent contradiction creates a very precarious policy mix. What really brought this to a head was the government looking to tighten fiscal policy by raising taxes at the exact same time the Bank of England is trying to fight inflation, likely by keeping interest rates high. Recall, the IMF has warned the bank to be very cautious about cutting rates. If the BOE eases while the Fed and ECB do not, it risks weakening the pound. But if it stays tight into higher taxes, the growth hit could come faster. This increases the odds that the tax hikes could trigger a recession before the Bank of England even gets inflation under control, potentially forcing it to reverse course on interest rates sooner than planned. Faced with a ballooning deficit and political promises it may be forced to break, the government is preparing for a high-stakes budget that will directly impact the finances of millions of households and businesses across the United Kingdom. As we look ahead, the things to watch will be the upcoming budget announcement for specific tax changes, the monthly inflation data, or CPI, and the Bank of England's guidance, and even the pound's reaction to see if this policy collision starts pushing the economy toward a slowdown. We were just talking about the UK government putting itself in a policy bind. Now, let's shift to the US, where the government is deliberately drawing a new line in the sand with China, one that runs straight through Wall Street. In an exclusive interview, Scott Bessent delivered a message that is rattling investors. His words, "We won't negotiate because the stock market is going down." A while back, we talked about how a willingness to use sharp domestic tactics could spill over into a harder line internationally. This is that stance made explicit, and believe it or not, this signals a major policy shift. For years, investors have relied on an unspoken guarantee, often called the presidential put. The idea is that if the market falls too far, the White House will step in to soothe investors. This is similar to the Fed put, where the central bank acts to support asset prices. Bessent's statement basically tears up that guarantee. Experts are calling this the Bessent Doctrine, and it means the government is prioritizing its China policy over short-term market stability. The bottom line is, this could permanently increase the risk premium for holding stocks as the government's safety net has been pulled away. We previously analysed the two-speed setup AI racing ahead while tariff pressure drags on the rest of the economy, and the latest development suggests that divergence could become more visible now that the policy safety net is gone. This declaration comes as markets have whipsawed violently in recent days. Stocks tanked late last week after new tariff threats, only to rebound, then dive again as the world's two largest economies teeter on the edge of a full-blown conflict. Continuing our last discussion about the likely return of aggressive trade tools, this week's escalation looks like the playbook we flagged, tariffs acting as a brake, just as the AI boom tries to floor the accelerator. But that's not the whole picture. The statement from Bessent was a direct response to a Wall Street Journal report claiming Chinese President Xi Jinping is betting the US economy can't absorb a prolonged trade war. This is important because it's not just an abstract bet. China appears to be actively testing this theory, for example, by using targeted export controls on critical materials like rare earth minerals. After all, things like gallium and germanium are essential for high-tech sectors in the US, especially for making the GPUs that power the AI boom and for electric vehicle batteries. A while back, we walked through how Asia, especially China, dominates these upstream choke points and how earlier export controls expose a real vulnerability in Western supply chains. Today's manoeuvring looks like a live fire test of that leverage. Bessent's reaction was explosive. He called that report terrible and then made the stunning accusation that the newspaper was taking CCP dictation. This move, however, introduces a new, more volatile element, information warfare. The situation presents a fascinating duality. On one side, it's a direct political attack, while on the other, it's a tactic designed to blur the line between official policy and propaganda. It creates massive uncertainty for investors and the public who rely on established media to understand what the government is actually doing. This is a leading indicator of strategic intent, suggesting the conflict is moving into a less predictable and more volatile phase. We've said before that institutional credibility is a market variable. This kind of messaging raises the stakes. A direct shot, not just at Beijing, but at a major American news outlet. This hardline stance is apparently coming from the top. According to Bessent, while Donald Trump likes a high stock market, he believes it is a result of good policies. the implication is clear. The policies come first, even if they cause short-term market pain. So why the confidence to say this now? The administration seems to believe it has an economic shield. The thinking is that a massive boom in capital expenditure driven by artificial intelligence makes the US economy strong enough to withstand this trade war. And there's some data to back this up. In the first half of this year, investment in things like information processing equipment, while a small part of the economy, accounted for over 90% of all GDP growth. However, this is a testable hypothesis. Relying so heavily on one sector is a big gamble. If the trade war disrupts the global supply chains that this AI boom depends on, this shield could prove less effective than hoped, and the pain could spread to the broader consumer economy. We previously highlighted that AI-related trade has been a major engine of global expansion, with Asia capturing the bulk of that growth, so any strain on those upstream inputs could quickly reveal how incomplete de-risking still is. This isn't just talk anymore, it's a high-stakes test of economic wills, with both sides signalling they are willing to endure the fallout. The message being sent to the markets is unambiguous. Brace for impact, because the government will not be changing course. So, looking ahead, what are the key signals? First, keep an eye on the VIX index, Wall Street's fear gauge. A sustained rise would show that investors are pricing in this new geopolitical risk. Second, watch the quarterly reports on business investment, specifically non-residential fixed investment. This will tell us if the AI capital expenditure boom, the supposed economic shield, is holding up. Finally, for our listeners in China, it's crucial to watch the exchange rate between the US dollar and the yuan. In this kind of environment, we could see a flight to quality where investors sell other currencies and buy US dollars, potentially putting downward pressure on the yuan. This also has implications for Chinese companies, as a stronger dollar makes it more expensive to pay off dollar-denominated debt. And as we flagged a while back, also keep an eye on prices for gallium, germanium, and other critical inputs, and the US inventory to sales ratio. If those start flashing red, it's an early signal that the two-speed economy is hitting its limits. Speaking of strategic reliance on China, that very issue is at the heart of another major economic headache unfolding in Europe. A seemingly impossible situation has become reality in the Netherlands, where one of Europe's most advanced economies is facing a grid crisis so severe it's costing them up to 35 billion euros a year. The Netherlands went all in on green energy, becoming the European leader for solar panels per person, with over a third of all homes now fitted with them. They've embraced electric cars and are building massive offshore wind farms. But this green revolution has a shocking side effect. It's overwhelming the country's power grid. So the thing is, this green transition happened at a blistering pace. Just to give you some perspective, according to the International Energy Agency, solar power capacity in the Netherlands increased fivefold in just 5 years between 2018 and 2023. The grid simply wasn't designed for such an explosive, decentralized expansion. The problem is the grid was built for a few large centralized power plants, not for millions of decentralized solar panels and wind turbines injecting power from all directions. The result is what experts call a massive traffic jam on the power grid. To put it simply, the old grid was like a few major highways designed for trucks leaving a central warehouse. Now, you have millions of small delivery vans from every neighborhood trying to get onto the highway and also trying to send packages back to the warehouse. It creates chaos in both directions, and the system freezes. And the consequences are staggering. 12,000 companies are on a waiting list just to get permission to use more electricity. 8,000 more are waiting to feed power back into the grid. Businesses can't expand. The president of the Dutch Chemical Association warns that grid congestion is putting the future of their entire industry at risk. It's even become difficult to build new housing because there's no capacity to connect new neighborhoods. This isn't just an inconvenience, it's a hard cap on the entire economy. The International Monetary Fund, the IMF, has specifically warned that these grid bottlenecks are a serious drag on the Netherlands' economic growth. When businesses can't invest and new homes can't be built, the whole economy suffers. This situation in the Netherlands is a warning sign for other European nations like Germany that are also pursuing rapid green transitions. The proposed fix is a €200 billion plan to reinforce the grid, laying 100,000 kilometres of new cable. But here's the catch. The grid operator says a single upgrade project takes 10 years to complete, and the first 8 of those years are just for getting permits. Here's where it gets interesting. This delay actually has a name. Experts call it a permitting tax. It's an invisible tax of time and bureaucracy that slows down growth. And this isn't just a Dutch problem. Similar administrative friction is threatening to delay major climate investment goals in the United States and Germany, making it a critical bottleneck for the entire Western world's green transition. However, if you zoom out, you'll see another layer of strategy at play. This massive upgrade plan creates a huge dilemma. To build out the grid quickly and affordably, they may need to rely heavily on key components like transformers and high voltage cables from Chinese producers. This raises a major strategic question for the EU. Do they prioritise speed and cost, which deepens their reliance on China's supply chain, or do they try to build up their own domestic manufacturing, which could be slower, more expensive, and even fuel inflation? This is a core policy challenge they must now confront. This has led to a situation that would have been unthinkable just a few years ago. The Dutch government is now running a TV campaign called Flip the Switch, begging citizens to use less electricity, and the financial incentives for homeowners to sell their solar power back to the grid are being slashed, with some now facing the prospect of having to pay to offload their excess power. What's crucial to understand is that this policy reversal could trigger a disinflationary bust in the green technology sector. For years, the story has been about a smooth, multi-decade green investment boom. But what we're seeing in the Netherlands suggests it could be more of a volatile boom and bust cycle. When subsidies disappear, demand for new solar panels and heat pumps could fall sharply, putting pressure on those industries. So what are the forward-looking indicators here? The key indicators will be the waiting list for grid connections if they keep growing. The economic drag will worsen. Also, keep an eye on any policy changes aimed at speeding up the permitting process. Finally, watch where the Netherlands and other EU countries decide to source their grid components from. Their choices will have major implications for trade relationships and the speed of the global energy transition. This report is for informational purposes only and does not constitute financial or investment advice. Market data is subject to change.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.